Hello, listeners. Today, we are going to talk on the topic the CapEx slowdown, a temporary blip or a sign of a caution for us. So, basically, in today's story, let's talk about the current slowdown in the capital expenditure in India, a trend that goes beyond business and affects all of us, including the job creation, infrastructure development. Lately, there has been a noticeable slowdown in capital expenditure, or which we refer as the capex in India. Simply put, capex is the money spent on long term investments like infrastructure projects such as roads, railways, power plants, and more. It's the government and private companies investing in things that keep the economy moving. And also, it creates the jobs whenever there is a capital expenditure made in the country. When capex slow downs, it shows that both the government as well as the business are cutting back on these major investments, which can have a big impact on the economy. And this is the same thing which is going on in India, wherein the capex has been slowed down. That is, the capital expenditure made by the privates as well as by the government is continuously slowing down, which means that the government is not investing more for the capital investment, neither the private are interested in making these sort of expenditures on the roads, railways, power plants, and others. Let's take a look at some numbers to understand the situation better. So, according to the India Data Hub, the central government's capital expenditure has fell by 15% in the first half of this year compared to the same period in the last year. This means the government is spending less on major projects, which has a big ripple effect. But this decline didn't happen all at once. Breaking it down by quarters, the first quarter took the biggest hit, with a steep 35.4% drop in the capex. That's a major cutback by us. However, there was some recovery in the second quarter, with capex growing by 14.6%. So while the decline wasn't as severe in the second part of the half, it still represents a noticeable drop. It's not just the central government pulling back, state governments are doing the same thing. The central government is also reducing its capital expenditure, as well as the state governments are also reducing its capital structure. According to the CARE Edge research, capital expenditure by state government has fell by 10.5% during the same period. This means that spending on critical projects is slowing down at both the central and state levels. Government capital expenditure is important because it serves as the backbone of India's investment cycle. When the government puts money into the infrastructure projects like building highways, expanding railways, or funding defense equipment, it doesn't create jobs and improve public facilities. This kind of spending also encourages private companies to invest. For example, if the government is investing in your area, if the government is making investment for making the roads, obviously there would be construction companies coming together for build the residential houses for the people. Also, the industries would be coming up because of the good infrastructure. So the same way applies in the government also. Whenever the government is making the expenditure on building the urban cities or rural areas, the private investment also flows. The private also makes the expenditure in making the factories and making more infrastructure available. So we can see if the government capital expenditure is decreasing, the same effect goes on for the private. The privates are also now not interested in making more capital expenditure. Government capital expenditure is very much important because it serves as the backbone of the India's investment cycle. As you can see, the India is a developing country. Till the time that India is not a developed country, all the investment expenditures need to be made by the government. Because if the government would not focus on the capital expenditures like railways, roads, and power segments, the private investments would also not take the motivation to do the investment. So, when the government puts money into the infrastructure projects like building highways, expanding railways, or funding defense equipments, it is creating the job, as we have understood that they are improving the public facilities. And also think of it as laying the foundation for economic growth. When the government leads with heavy investment, private businesses, office flow suit. That is, they also make this same type of investment for the growth. Right now, however, the government's three major area of capital spending, which is defense, roads, and railways, are all facing the cuts. So the defense is also not making the capital expenditure. Neither the roads are seeing the good capital expenditure, and the railways is also not seeing any big capital expenditure. These three sectors make up about 75 to 80% of the central government's capital expenditure. And now you can think that if the government is cutting the expenses on these capital expenditure, so the government is thinking of something else. The government is now not interested in making the capital expenditure, which made 75 to 80% of their expenditure. So any slowdown here has a big impact. Here's what the numbers show. Defense spending is down by 15.2%. If the government used to spend 100 crore rupees, now the government is spending less 15%, that is less 15 crores. Now the government is only spending 85 crores. Spending on road projects has dropped by 10.1%. If the government has been spending 100 crores, this means now the government is spending only 90 crores, 10 crores less. Railways investment have dipped by 4.8%, which means if the government was spending 100 crores, now the government is only spending 95 crores on the railways. In short, all the key areas that usually get a lot of government funding have slowed down, and that doesn't bode well for the long term economic growth. Now, let's talk about private sector spending. So, the research looked at data from 1074 non financial listed companies and found that their combined capital expenditure this year was 9.4 lakh crores, down from 9.5 lakh crores last year. The same effect, the ripple effect, which we can see if the government is not interested in making the expenditure, nor the private investments would be taking a lead. So the same way goes for the private. The private only makes the capital expenditure when they see that the government is making the expenditure. While this isn't a huge drop, it does show that these companies aren't increasing their investments either. When we take a closer look, we can see that private investments are mainly focused on a few key sectors: oil and petrochemicals, power, telecom, automobiles, and iron and steel companies. These industries are crucial for keeping the economy running smoothly. So when they hold back on spending, it often reflects concerns about the future. The slowdown is not caused by just one factor. It's a mix of several things that some might describe as a perfect storm. For example, election-related restrictions in the first quarter limited how much the government could spend. Because if the government is making the investment, this shows that the government has been spending so as to gain the vote during the election. So this is the reason the government was not spending more money. Second thing, the weak domestic demand. People are not spending as much and businesses are reacting by being cautious. So this way we can see because there is no domestic demand, the firms are not interested in producing more goods. Third point, geopolitical tensions around the world are making companies wary of long-term investments. As we can see that the Adani Ports has also made the investments in the foreign countries and they are facing a lot of troubles. The Ukraine-Russia war is continuously going on. This is again making very much trouble for the companies in India. Should they make the investments in the foreign country or not? Because there is geopolitical tension going on continuously. Next point, the Chinese oversupply. China's high production levels are affecting markets globally, putting pressure on Indian economies. If you have seen our last videos, you would have seen that the China's retirement age is continuously increasing because the China's economy is not having young population. And they are continuously focusing on more production and dumping their old products to the countries like India and other countries. So if you have seen our last video, you can quickly see the thing that the China is oversupplying their goods and they are dumping their goods to the foreign countries. The next point, which relates why the capital expenditure is less, is because of higher borrowing costs due to the rising interest rates are making it more expensive for businesses to fund new projects. For this content also, if you have seen our last video in which we have mentioned that the Fed is continuously increasing their rates. And if the same thing goes on, the India's central bank, Reserve Bank of India, would also come up with a change in their interest rates. And the Fed has now taken the decision that they are decreasing their rates. So that India also needs to do the same thing because it has always been the same situation. Whenever Federal Reserve of USA reacts, in the same way, India also looks for these situations. All of these factors together help explain why the companies and governments are being careful with their spending on big projects. The caution is understandable, but it does mean fewer new projects which could slow down economic growth in the long run. The central government has set a big target for this year's capital spending. To hit that goal, spending in the second half of this year needs to grow by a whopping 50.5%. But here's the catch. Reaching such a high growth rate is not easy. A leading company says the CapEx growth has rarely gone past 25% in the last 5 years. The only exception was in financial year 2022 when it surged by 57%, which was a rare spike. And this was the reason because just after the COVID, many of the companies which were thinking of making the investment, they have made the investment in the year 2022. So this was the reason where the CapEx expenditure has been increasing. So aiming for a 50.5% growth rate this year will be a tough challenge for us in India, but we can say that India is keen on doing the investment. That said, while the slowdown is real and concerning, there are some signs it could be temporary. For example, the capital good companies are seeing an increase in the orders. If there are more demand, if there are more orders, obviously they need to make more goods also to be supplied. It reports there the order head grew by 23.6% in the financial year 2024, a huge jump compared to the average growth of 4.5% over the last 4 years. Second is the infrastructure companies are also showing positive signs. They experienced a 15% decline in order books in financial year 2024, but have bounced back by 20.5% growth rate in just first half of this fiscal year. These numbers suggest that even though there was a dip in the capital expenditure, companies might be on their way back, hinting at a possible recovery soon. Looking forward, the research is forecasting a strong GDP growth rate of around 7.2% to 7.3% for the third and fourth quarters of this fiscal year. This could bring India's annual GDP growth to nearly 7% in financial year 2025. These projections show that despite the current slowdown in the capital expenditure, the fundamentals of India's growth are still solid and still the foreign investors are looking in India to do the investment. With election-related restrictions now behind us, there's a good chance that capex level could pick up again as both government and private companies regain the confidence that they need to come up with the good infrastructure for the country. So while the current capex slowdown is worth keeping an eye on, it's not all bad. There are signs of improvement, and with positive GDP, gross domestic product, growth projections, the Indian economy might just get past this temporary hurdle. So we can see that the India would doing the capital expenditure, and this would be made both by the government as well as by the private enterprises. If you have liked our video, do share it with your friends, subscribe to our channel,